One opportunity that potentially is arising as we come into the end of the year is a more hawkish shift that we've seen from the Federal Reserve. Now, on September the 22nd, there were a few key indicators that Jerome Powell really showed his hand to the market. The first thing to note was the fact that the Fed's test about whether it was right to start tapering has been all but met. And this is where Fed Chair Powell said many on the committee think that the test for employment to taper has been met, and others think it's close. His own view that it's all but met. So what that means is that the inflation test has been met. Many think employment has been met. So Jerome Powell is really laying the foundations for tapering to be announced in November. And he said, as a surprise, as if economy remains on track, that tapering could conclude in the middle of 2022. So a more aggressive tapering of bond purchases was being projected by Jerome Powell. And that was also reflected in the dot plot, with a dot plot see nine dot C hikes in 2022 and 17 dot C hike in 2023 versus a previous 13 and 7 respectively. So it's a more hawkish outlook after Jerome Powell's press conference. And that really opens up a potential heading into the year end that the Federal Reserve is on a more aggressive stance. Now, this was noticed by ourselves, and we flagged this up at the time. You can see here Arno just flagging up that there's a more hawkish twist from the FOMC, and the obvious pair to look at trading was the US dollar Japanese yen longs. And we looked at this pair breaking out of a daily symmetrical triangle just after the rate decision was made around the September the 24th. It sort of just broke out of that symmetrical triangle position. And you can see here on the chart how that played out, just breaking out of the symmetrical triangle pattern, and then prices just moved into this overhead resistance. Now, this was the obvious place to take profit from that symmetrical triangle breakout. It's a key overhead weekly resistance area, so it's not surprising to see a little bit of a pullback. However, if the Federal Reserve remains on their current stance, then we would anticipate to find buyers from a pullback. Notice this surge higher in the US 10-year yields. You can see here that the US 10-year yields and the US dollar Japanese yen move very closely in tandem, and the breakout in the dollar yen was also supported with a breakout above this sort of 1.3 region in US 10-year yields. So this is a bullish breakout in both yields and dragging the US dollar yen high, which is exactly what you would expect. So the key support region remains any dips back lower to this 110.80, 110 region. An ideal entry would be a retest of this 110 region, which is just a retest of this symmetrical triangle breakout pattern. We may or may not get it. However, should the Fed remain on course, then we would expect the US dollar Japanese yen pair to keep moving higher. So it is a potentially a good trade to get into for the rest of the year. Now, the first kind of test is going to be the non-farm payrolls coming up on the 8th of October. And if those jobs print a very strong number above maximum market expectations, then we know that Jerome Powell is going to say that the employment test has been met from his perspective. He said he didn't need to see a really fantastic jobs print to think that the test had been met. He said it's all but met. In other words, what he's really saying, we're pretty much there. So just one good, solid jobs report would give Jerome Powell the reassurance, and we can see from the dot plot that many on the FOMC, as has been stated, already think that employment test has been met. The inflation test has been met. Many are concerned about rising inflation. So all of that would mean that US 10-year yields should keep moving and the dollar yen should keep moving. Now, if there's a disappointing jobs, on the other hand, then that could mean the market begins to question the Fed's more aggressive stance. So a very interesting chart to look at there, we'll be looking at the gold chart. Because if the non-farm payroll print disappoints, if it's a big disappointment, then the Fed might be expected to delay tapering potentially, and that would result in a little bit of a retracement in the dollar, 10-year yields moving lower, the US dollar moving lower, and that should be supportive of gold. Note this very strong bullish pin bar on the weekly chart. Body, very bullish, closing within the body of the previous candle, long tail, space to the left. Everything's very attractive from a technical perspective, and if we get the fundamentals agreeing, so a very weak jobs print which would question the Fed's timescale, then we could anticipate that being potentially supportive for gold in the near term. So there's a couple of markets to be watching based on the current projection of the Fed's policy and what we would expect if the policy is confirmed with a good jobs print, or if the policy can be questioned with a weak jobs print. We can look at either the US dollar Japanese yen or the gold chart for potential opportunities.